If you have been told that every business owner should be an S corporation, I want you to stop right here, because what most people do not tell you is the full picture. They give you half the strategy and leave you to figure out the rest. Today, we are going to talk about whether an S Corp is actually the right move for your situation, because what works for your neighbor may cost you money. Here's what you hear all the time: elect an S Corp status and you will save on self-employment taxes. And that part is true. As a sole proprietor or single member LLC, you pay self-employment tax, which is 15.3% on your entire net profit. That's both the employee and the employer share of Social Security and Medicare. With an S Corp, you must pay yourself a reasonable salary. You pay payroll taxes on that salary, not on the distribution you take on top of it. That's where the savings come in. Sounds great, right? But here's what they are not telling you. The IRS requires that you pay yourself a reasonable compensation for the work you do in your business. You can't pay yourself $1 a year and take the rest as distributions. If you do, the IRS will recategorize those distributions as wages, and you will owe back taxes, penalties, and interest. Once you are an S Corp, you have to run payroll. That means payroll taxes, quarterly filings, W-2s, and very likely payroll software or a payroll service. That is a real cost every single month. S Corp have separate tax return. Form 1120S, that means higher accounting fees. There are state filing requirements, registered agent fees, and annual reports in many states. By the time you add up payroll costs, accounting fees, and state fees, you might be spending $3,000 to $6,000 or more per year just to maintain the S Corp structure. So the question isn't whether an S corporation saves taxes in theory. The question is, does it save enough to justify all of that? You've probably heard someone say, once you are making $40,000 in profit or $50,000 in profit, elect an S Corp status. That number is a starting point, not a rule, and it definitely is not one size fits all. Your break-even point depends on your specific reasonable salary, your state, your payroll cost, and your accounting costs. For some business owners, the math works beautifully at $60,000 in profits. For others, it does not pencil out until $100,000. And for some, especially those with young children, there is actually a better strategy that I want to talk about right now. If you have minor children, listen closely, because this might be the most powerful tax strategy available to you right now. As a sole proprietor or single member LLC, you can hire minor children to work in your business. And when you do, you get a tax deduction for their wages, just like any other business expense. But here's what makes it so powerful. Your child's wages are exempt from Social Security and Medicare taxes when they work for a parent's unincorporated business. That means no payroll taxes on those wages. And your child, they have their own standard deduction, over $16,000 in 2026. So if you pay your child up to that amount, they pay zero federal income tax on those wages. If you have two minor children and you pay each one of them up to $16,100, that is more than $30,000 in deductions coming off your taxable income. If you are in the 22% tax bracket, that is potentially over $6,400 in tax saving. And you didn't need to form an S Corp, run payroll for yourself, or pay higher accounting fees to get there. Now, can you do this inside an S Corp? Technically, yes. You can hire your kids, but you lose the payroll tax exemption. Inside an S corporation, the wages paid to your children are subject to payroll taxes because the exemption only applies to wages paid by a parent's LLC or partnership, not a corporation. So if hiring your kids is a strategy you want to use, the S Corp may actually cost you more than it saves you. This is the most important thing I want you to take away today. Your situation is unique. There is no single tax strategy that works for every business owner. The right structure depends on your income level, your family situation, your business expenses, your state, your goals, and frankly, your stage of business. S Corps are a powerful tool. Hiring your children is a powerful tool, but a tool in the wrong hands or in the wrong situation does not build anything. It just creates more work and more costs. I've seen business owners rush into S Corp elections because someone in a Facebook group told them to, without ever sitting down and running the numbers for their actual business. And I've seen the confusion and the unexpected tax bill that come from that. Before you make any structural decision for your business, work with a qualified tax professional who will look at your numbers, your family situation, and your goals, and then give you a recommendation that's built for you. If you are a business owner who wants to actually understand your tax strategy, not just follow someone else's templates, I'd love to connect with you. Head over to nourasbooks.com to learn more about our tax planning services. We do not do cookie cutter advice. We look at your complete picture and build a strategy around your life and your business. Because at the end of the day, the best tax strategy isn't the one that is trending. It's the one that works for you. I am Noura al-Masri, and I'll see you next Monday.